This channel is very different to most other channels here on YouTube. On most other channels you see people reading the news or reading the white papers of the next small cryptocurrency that they will then subsequently pump and dump. But on this channel I go a quantitative approach, a data-driven approach. I try to figure out what are the rules that historically worked very well in the past and that also have a high likelihood of continuing to work in the future. Now, if this is not your first time here, you've probably heard of this indicator here, the 120-day simple moving average. Most other channels talk about the 30-day, the 100-day, the 200-day. There's no channel that talks about the 120-day simple moving average. But this number is not just chosen at random. But if this is not your first time here, I'm not going to reiterate every single detail of that strategy. Instead, we're going to go through a few refinements. But in general, the idea is the following. We want to bet on rising prices whenever we are above the moving average, and we want to bet on falling prices or at least be in cash whenever we are below the moving average. When you follow this strategy, when we buy when we are above and we sell when we are below, then when we check out the different moving averages, the 120-day SMA historically worked the best for Bitcoin. And so here's a quick recap of that backtest. We're going to go into the details in a second. So I've backtested the simple moving average and the exponential moving average from the 2-day all the way to the 200-day. And this is annualized performances. And I just want to figure out what's the best duration. So for the SMA and for the EMA. Now the EMA tended to underperform the SMA most of the time. So let's just focus on the SMA, the simple moving average. This is now a representation of almost 200 backtests. So had we just bought and held Bitcoin during the time, we would get the return that's indicated by the black horizontal line. But when we trade according to the moving average, we either underperform or we outperform. We tend to outperform once we go beyond a duration of 30 days. Everything that's below 30 days tends to incur too much trading fees. But once we go beyond the 30-day mark, we tend to do better, and the 120-day SMA historically outperformed buying and holding massively. So that's then how that looks like over time. Bitcoin is the line in white, and the back-tested performance is this line in turquoise. Now this is just a linear scale. We can't really see what happened in the early days. So here we've got the same thing on a logarithmic scale. Now with every horizontal marker, we get a 10x from one another, and we can clearly see how this outperforms very nicely and consistently. But there's something very important to mention here. This strategy goes both long and short. So we bet on rising prices whenever we are above the moving average, and we bet on falling prices whenever we are below the moving average. Now we can split this strategy into two segments. What if we only go long whenever we are above the moving average and we only go short whenever we are below the moving average? How much of this performance is due to the longing and due to the shorting of the asset? So again, the idea is we bet on rising prices when we are above, we bet on falling prices when we are below. And what happens if we don't actually bet on falling prices when we are below, but we just get into cash? So we never want to bet on falling prices of Bitcoin. This is too risky to us. Let's say we only bet on rising prices. What is then our performance? And the answer is this chart over here. We still outperform buying and holding Bitcoin quite a bit, but not by as much. So here our end result is roughly 30K. We start at 1K. And if we do both longing and shorting, our end result is at 175K. So there is a difference. Now let's say we do the exact opposite. We never want to buy Bitcoin. Let's say we are super negative on the asset. We think that crypto is a scam. All we want to do is we short Bitcoin, and we do this during bear markets. So we make money while the price here is coming down, and we just exit. We are in cash whenever we are above. If we follow that strategy, we get this return here. So that turns $1,000 into $6,000. It's still a moneymaker. And notice how we do not appreciate whenever the Bitcoin price is going up. We're just in cash, but we do make money during the bear market. Now, what I find fascinating about this chart is that it shows how strong the 120-day simple moving average is. We've got an asset like Bitcoin that tends to rise very, very long term, very aggressively. But still, if we use the 120-day SMA and all we can do is just betting on falling prices, we can still get the same kind of return compared to just buying and holding Bitcoin. Isn't that fascinating? I don't think that's that easy to achieve. This is the perfect hedging strategy, as in we still get the same kind of return, but we always make that return when most other people are losing their money. Now let's get with the more standard strategy again, right? We bet on rising prices whenever the momentum is positive, and we get into cash whenever we are below. We are not betting on falling prices at all, and currently we are below the 120-day SMA. We could go above again, right? This happens all the time. We do have our failed signals where we buy high and sell low again, we buy high and sell low again. But on average, this strategy works. We have a few small losing trades, every now and then a big winning trade that makes up for those small losses. That's in the end the idea of this trend following strategy, right? We also never buy at the exact bottom. We never sell at the exact top. It's simply just a strategy that waits for the trend to get established. And so let's say we now get into cash and we don't go back until we go above that 120-day SMA, which by the way is currently at $109,900. What's the best way to execute this strategy? Now I'm following this approach already for quite a while. And in the early days, all I did was simply just buy and sell Bitcoin. So now that we are below, I would simply go to a decentralized exchange and I would exchange my wrapped Bitcoin into a stablecoin like Tether or USDC. But I've now refined the strategy somewhat. Because in the end, it's not just about finding the right trading signals, it's also about optimizing fees, right? Whenever we go in and out of an asset, with decentralized exchanges, we tend to pay 0.2, 0.3% trading fees. I've also included that in the backtest, by the way, so 0.2% trading fees. But we can actually reduce those fees, and we can even make money when we are in cash. So here's what I'm personally currently doing. Instead of selling my Bitcoin, I open a short position that hedges the spot Bitcoin that I open. So I'm long with my spot, right? I own Bitcoin, but at the same time, I bet on falling prices with the same amount so that net, the price exposure is flat. I'm not gaining and I'm not losing anything when we are below the 120-day SMA. Now, what's the advantage of doing that over just selling the Bitcoin? The first advantage is that our spread is much, much smaller. So instead of paying 0.2% every time, we only pay 0.001%. So there's very, very little spread. There's pretty much no slippage at all for any reasonable amounts. And this already over time, of course, adds up. When we look at the number of trades, let's say in the last 2 years or so, we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. We've got 18 trades roughly. Let's round it up to 20. So that's 4% over the course of 2 years. 2% additional return pretty much for free every single year without any additional risk. But then, and this is where the real kicker comes in, especially for shorting, we get additional return. We get the funding rate. So at my current exposure of roughly $500,000, I get around $100 to $150 additional return for funding, because the funding rate here on Hyperliquid is close to 11%. And this is what the longs have to pay the shorts. This does fluctuate a bit depending on demand, but this is additional return that we get just like this for free. So we're saving on slippage and we also get the funding rate. Now this only works, of course, on the short position, right? If we want to get more exposure by going long, we suddenly have to pay the funding rate. So perpetual futures, right, this is what this platform is using. Perpetual futures are great for short positions and they're great for short-term speculation, as in when we want to get in and out of positions very quickly. If we want to hold an asset for many, many months and we want to get the positive price exposure, then we should not use perpetual futures. Then we should just buy the spot market. But I like this approach a lot because we don't need that much capital to hedge because we do have the leverage. And of course, I set the leverage in a way that the liquidation price will be quite a bit above the moving average, right? I only close that position once we close a day above that moving average. So I don't look at the prices within the day. I just look at the price once per day at UTC midnight time zone. This is also what the backtest did. So I very likely will not get liquidated before selling this position myself. At the same time, we get nice funding rate and we have this performance long term. We are not exposed to the market as the price is going down. And yes, of course, we could also add the shorting position to that strategy. It long term makes more money, but of course, it always feels a little bit off to short an asset that very long term tends to appreciate. My thinking around this is in general to rather just short the altcoins when we are in a bear market. Because altcoins tend to do worse than Bitcoin most of the time. So instead of getting net delta negative on Bitcoin, I would just open short positions, naked short positions on altcoins, just to have this negative delta exposure and to potentially gain even more. Why short the asset that tends to appreciate the most long term when we can short the assets that are highly correlated to that hardest form of money that tend to go down long term, right? right? I think it makes more sense to just short the alts, potentially without hedge or with less hedge when we are below the moving average. But again, right now, it looks like we could be at a turning point, as in there is a chance that we might enter a significant correction from here. It's not certain, but if we followed a strategy like this in the past, it tended to protect us against quite massive moves to the downside. Right now, things still appear very bullish, as in money is flowing into the market, the stablecoin market cap is going up, money is flowing into the market through the ETFs as well and through the treasury companies. So everything still seems to scream that prices will continue to rise, but I simply just want to have some kind of additional hedging mechanism to be out of the market quickly enough in case we do see a turnaround, in case momentum does slow down. I do not have a crystal ball. I believe statistics more than my gut feeling, and that's why I take this hedging position. I'm very happy in case we turn around and we get bullish tomorrow again, but I'm also okay in case we fall further, because then my net worth measured in Bitcoin will go up, and I then get exposure to the market early enough again. At least historically, this strategy went into the market early enough to take advantage of the rallies. That's the whole idea, right? We've got risk mitigation during bad times, but we still take advantage of the rallies during good times. And the 120-day simple moving average is just the best tool for Bitcoin. At least it used to be the best tool. Who knows what's going to work in the future? But this is the best educated guess that I personally have and that I'm also following. Now, if you've watched a few videos on this channel already, you might see that I approach crypto quite differently to most others. Most others just try to find the next meme coin that does the 10 or the 100x return, but more often than not, those kind of bets just go to zero. I do the exact opposite. I bet on falling prices of the crappy altcoins, and I started trading for this community on the 10th of July. And so far, things are developing very, very nicely. The annualized performance is 79%, while the maximum drawdown was only 2.3%. So this is the exact opposite of buying a meme coin, where you're losing most of the time and you're hoping for this one lucky moonshot. When I look at other people here on YouTube, I don't really see them being that open, as that they show directly what performance they are doing versus the market in real time. And I also don't see them just trading for the community, because it's not that easy to walk the walk, right? Most people just talk the talk. It's easy. Words are cheap, but performance is actually what matters. What I like most about this performance is that we started trading over here and Bitcoin went up and down and up and down. We already had our 12% corrections, and at the same time, the capital pool simply constantly appreciated, with again very little volatility. And so this is how most people get burnt in crypto, right? They see a meme coin, for example, how it's going up, and they're wondering how much higher can it go. So for example, this here, Bonk, right? Bonk shoots up. People consider, hey, should I maybe buy? They might be buying over here, and then things turn out positive short term, but then the exit is never found. Then the asset just continues to get held over time, and then prices crash further and further. And then as we settle at a lower price, that's when most people sell. Another rally follows. The hope is that Bonk reaches similar heights to the prior heights, and again, it doesn't work out. The issue really is that those exit points are much harder to find than the entry points. Prices tend to be low for a longer time than they tend to be high. Those exits are just very brief moments in time. It's the same with everything, right? It's also with Fartcoin, as in the exit is the hard thing. The entry is okay. Buying when nobody is looking is somewhat possible, but selling when we peak in the price just for a few days, that's really what gets wrecked most people. Most people don't exit on time and then just see the price coming back down. The effect is of course the strongest with the meme coins. Right here we've got Dogecoin, the same thing. Things go up quickly. There's a few days where it might make sense to sell, and then if those days are missed, the opportunity of selling is gone again. I try to approach the market very differently. I try to look at what are most altcoins actually doing long term, especially the altcoins that have very high token inflation, where more and more tokens hit the market because the insiders want to sell, because the venture capitalists, they get now token unlocks. They are selling constantly and they depress certain altcoins long term. And I'm simply just betting on those altcoins continuing to do worse compared to the rest of the market. And that's how I make this long-term outperformance, and especially outperformance that's independent of the general market environment. This is one of my favorite websites. It's Tokenomics.ai. It lists various altcoins with their token unlocked. And let's have a look, for example, at fetch.ai. It went crashing and burning, and it's close to an all-time low relative to Ethereum. And the reason is, of course, token unlocks, as in there's more and more tokens that hit the market. And that depresses the price if the demand doesn't grow as quickly. And that's usually the case. Have a look at this jump over here, right, in July of 2024. This is really where Ethereum outperformed Fetch AI massively. Ethereum doesn't have all those unlocks. Ethereum's supply increase is very, very modest, but it's not modest for most altcoins. And that's where we see the outperformance of Ethereum relative to Fetch AI. This here is an outperformance of 177%. Have a look at this. I like to trash on this altcoin all the time here publicly on YouTube. This is Balancer. This is the supply of Balancer tokens over time. The Balancer DeFi protocol started with 20 million worth of tokens, and now the liquidity mining expands that supply further and further. And now we are at roughly 70 million BAL tokens. And here's Ethereum relative to Balancer. So it's just outperforming all the time. Or in other words, Balancer is doing worse. And this is how we make the performance. Balancer has no usage at all. The total value locked in Ethereum is going down. The number of tokens is going up. And so, of course, we see constant underperformance. And that's what we can make become our profit. So this again, Ethereum relative to Balancer. This blue line over here, that's the Ethereum price itself. So that's how much of a difference this makes, right? Ethereum crashes and rallies and crashes again and rallies again. Or you just get constant outperformance with those relative valuation bets. Or have a look at this at the bottom. This is the Bitcoin price during the same time. Again, Bitcoin can crash by more than 70%. And our position here just continues rising. The alpha in crypto is to simply do the same thing that the insiders are doing. The insiders are dumping on retail by having more and more token allocation. And we simply just have to make similar kinds of moves. When they are depressing the price and they make money with their price depression, we simply do the same. We are not insiders as in we don't really know what's going on with the project, but we do know that the project will have more and more tokens over time. And those tokens will be selling pressure. Now, unfortunately, the capital pool has already closed for deposits until end of the year. There will be a new capital pool starting in 2026, but for now, we are just trading with the capital that's currently available that has already been deposited. But there's still a way to make the same kind of performance because I still share every single trade that I make for the community pool. I still share that in a dedicated channel. And I want to share the two recent trades. For example, here I closed the Filecoin short after an underperformance of 8% in just 9 days. So we short over here, the price is going down. And then over here, we've got another one. Trump relative to Solana, it underperformed by 23% within 3 weeks. I'm closing those shorts after they get close to the lower end of the trading range. And then I look for the next entry opportunity once we are higher again. The background of those shorts is, of course, again, token inflation. Just have a look at Tokenomics.ai, see what Filecoin and Trump have listed as their tokenomics. But yeah, you can simply just copy trade whatever I'm trading. So here are a few wins of community members that post their gains here as well. Now, I understand the doubts. Just because I've been successful with this strategy doesn't necessarily mean that everybody that makes similar trades will also be successful. But I want to make this as simple as possible, and I also want to make this as risk-free as possible. So here's my offer for the first quick win. You simply join Premium and watch 2 videos that are 1 hour in total in length. You're watching this one over here, using perpetual futures on Hyperliquid to bet on relative valuations. And you watch this one over here, very important, risk management with relative valuation bets. Once you've watched those 2 videos, you know exactly how to set up trades like this or trades like this, so that you don't continue losing money with roller coasters like this. Once you've watched those 2 videos, then please join the community chats. When you've joined the chats, I will get an alert message that you have joined Premium, and I will send you a direct message with my current favorite trade. A trade very similar to Balancer. Now, Balancer's token supply is getting close to its maximum cap, so it's not necessarily the best trade anymore. But it's a very similar trade that's still early in its infancy. It's likely going to perform very similar to this trade. Now I will share my favorite trade with you, but also I will put a little guarantee to this. When you join this trade and you're not making money after 1 month of holding this position, then I will refund the membership fee to you 100%, no questions asked. So you can simply join premium, join this trade. If you don't make money with it, again, you just get this money back. It's pretty much risk-free. You learn everything. You learn how to make all of those relative valuation trades. You can binge watch all the tutorials. You can just copy trade whatever I trade. If this initial trade that I'm sharing with you won't make money, you get that all for free. You're just risking the 125 US dollars, but if you're not successful, you get the money back. Now the capital pool has already closed, but there will be a new pool at the beginning of next year. And if you want to be notified first before that second pool closes as well, then feel free to join the annual membership. You can start with monthly and then switch to annual later. You do not get access to the automated copy trading with the annual membership right now, but you will get a first invite as an annual member in January of 2026. A link to premium will pop up directly on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.